The JPMorgan Japan Investment Trust has an unconstrained strategy. That means that if we don't like a company, we don't own it. We only invest in the very best companies with the outstanding prospects over the next 5 and 10 years and beyond. The Japanese market is very under-researched. In fact, half of companies have 1 or 0 analysts from an investment bank writing about them. So there's a tremendous opportunity for discovering hidden gems. We really are at the heart of Japan's new growth for the JPMorgan Japan's Investment Trust. What we mean is we're looking for the real next generation of growth companies in Japan, but we're doing that from a base in Tokyo where all our team are. Being based there is so important when we can meet all new companies that are IPOing and really see what those changes are on the ground. There's a new generation of dynamic, new Japanese companies that often have younger management, very focused business models, management that own shares in the company, which is something that we don't often see from more traditional companies. And there are tremendous opportunities in newer areas like e-commerce or cashless payments, where surprisingly, Japan is often lagging behind the rest of the world. The quality focus of the trust is very important. What that means is that we're looking for companies that are number 1 globally or within their niche in Japan. It means they have very strong balance sheets, great free cash flow, and are really number 1 at what they do. JPMorgan Japan Investment Trust has a very long history. We've been committed to Japanese equities for many decades now. And the large size of the trust means that we really are the go-to vehicle for investing in the Japanese market. Geopolitical issues are certainly playing a part right now, particularly the difficulties in Ukraine, which is pushing up the costs of food and commodities in general. Also, because the yen is weaker, that is also making the cost of these items rise quite sharply. So for the average Japanese person, there certainly are pressures right now. However, for the trust, we're really focusing on quality companies that can cope with any environment, whether that be inflation or weaker yen or geopolitical troubles. They've stood the test of time and they have business models that are very proven. When we're looking to identify structurally robust Japanese companies, we often look overseas. Now, we're very fortunate at JPMorgan to have a team of analysts based all over the world, whether that be in New York or London, Shanghai, Hong Kong. And because Japan is often following the global trend, it helps us to identify what the big winners of tomorrow will be. I often think it's a bit like watching a movie where we are really just on the opening credits, whereas a lot of my colleagues may be already halfway through. And that is a tremendous source of competitive advantage when we're looking to identify those structural trends and winners. We place a lot of emphasis on identifying high-quality Japanese companies, but I like to think that we're looking to buy the best companies that happen to be listed in Japan rather than just Japanese companies per se. If these companies were listed anywhere in the world, people would think that they are extremely high quality franchises. And one of the great things about this business is that they have the financial robustness, they have long growth runways, they have very established profitability, high levels of profitability and returns on equity. And those are exactly the types of businesses that we think will be able to survive even the most difficult of environments, as we've seen them do before. For example, during the financial crisis in 2008, the large Japanese earthquake in 2011, and more recently, the COVID pandemic. The mood of the businesses we're speaking to right now, I think, are cautiously optimistic. We see companies benefiting from reopening because Japan has been quite late to reopen following COVID. We also see what I think is nothing short of a shareholder revolution companies returning more money to shareholders via buybacks or dividends. It's on an unprecedented scale and it's at a very early stage. I think the fact that we see that happening right now just goes to illustrate how confident Japanese companies are feeling about their long-term prospects. COVID-19 certainly accelerated a lot of trends that we see in Japan, but there's certainly a long way to go. So just for some examples, before the pandemic, roughly 9% of retail sales were online. Right now, it's about 11%. That is dramatically lower than most developed countries. Or take cashless payments, for example. Before the pandemic, roughly 80% of transactions were carried out using cash. That's now around 70%, but it is still a very, very high number. And I certainly find it noticeable when I'm traveling around Japan with the family that we need to take cash with us still. In fact, we were in a service station on a motorway very recently where there was a big sign saying cash only. Can you imagine seeing that when you're driving up or down the M1 and you're in a very large service station? I think it just gives a sense of just how early stage these opportunities in these very attractive industries are. I'm very confident in the long-term fundamentals of the companies that we own. They have very robust balance sheets, very strong growth outlooks, and that's really something that is specific to what we own. And it's really about owning the best companies that happen to be listed in Japan rather than just the Japanese market overall, where there are certain sectors which have some serious structural issues. There are many opportunities for long-term sustainable capital growth in the Japanese market, but just to pick up one specific area we find very exciting and where I think actually the prospects have improved over the last couple of years, that would be factory automation and robotics. As wages rise across the world, there is a new imperative for companies producing manufacturing items or operating warehouses to do something about that issue. And automation is the number one thing they could do. Now, we're extremely fortunate in Japan to have the world's leading businesses in this area, pure play companies that only focus on this. Companies like Keyence, which makes sensors used in production lines, has an operating margin of over 55%. SMC in pneumatic equipment has an operating margin of over 40%, and they have very long structural growth runways.